Welcome to Forex Central. We're thrilled to have you join our YouTube, Facebook and Telegram channel dedicated to all things Forex. Here, you'll find a community of passionate traders, investors, and enthusiasts who share a common goal of achieving financial success through the exciting world of foreign exchange. Stay tuned for regular updates, trading tips, market insights, and educational content that will empower you to make informed decisions and navigate the Forex market with confidence. We believe in the power of knowledge and collaboration, so feel free to engage with fellow members, ask questions, and share your experiences. At Forex Central, we're committed to creating a supportive and inclusive environment where everyone can learn, grow, and thrive. Our channel is designed to be a hub of valuable information, resources, and opportunities that can help you unlock your trading potential. Thank you for being a part of Forex Central. Get ready to explore, connect, and embark on an exciting journey towards financial freedom. Happy trading! Forex Central Weekly Gold Analysis for July 10 to 14, 2023. Preparable scenario is a sell entry at 1935, sell stop loss at 1942, sell take profit 1 at 1920, sell take profit 2 at 1914, sell take profit 3 at 1902. For gold support and resistance analysis, support 1 at 1920 to 1914, support 2 at 1895 to 1890, support 3 at 1880 to 1975, resistance 1 at 1933 to 1940, resistance 2 at 1953 to 1960. For gold trend analysis, for long term it's downtrend, for short term it's uptrend. For Forex Central Daily Gold Analysis, July 10, 2023, preparable scenario is a sell entry at 1935, sell stop loss at 1942, sell take profit 1 at 1920, sell take profit 2 at 1914, sell take profit 3 at 1902. It has a risk-reward ratio of 465, with 327 pips possible profit. This is a VIP level signal. There is a lack of major news releases. When there is a lack of major news releases, the market can experience a relatively quieter period, with potentially lower levels of volatility. Here are some potential outcomes and characteristics during such times. 1. Reduced volatility. Without significant news releases, market volatility tends to subside, as there is a lack of fresh information to drive significant price movements. Traders may adopt a more cautious approach, leading to relatively stable market conditions. 2. Narrower trading ranges. In the absence of major news releases, trading ranges may become narrower, price movements may be limited, and the market may exhibit a more range-bound behavior, with prices fluctuating within a relatively tight range. 3. Lower trading volume. The absence of significant news can result in lower trading volumes, as market participants may be less motivated to execute large trades or take significant positions. This can lead to decreased liquidity in the market. 4. Increased influence of technical analysis. During periods with a lack of major news, technical analysis tends to play a more prominent role in guiding trading decisions. Traders may rely on chart patterns, indicators, and historical price levels to identify potential trading opportunities. 5. Focus on macro factors. In the absence of immediate news releases, market participants may pay more attention to macroeconomic factors and long-term trends. Economic indicators, central bank actions, geopolitical developments, and other fundamental factors may garner increased attention. 6. Sentiment and market psychology. Market sentiment and psychology may become more influential during times without major news releases. Traders may rely on broader market sentiment, investor confidence, and risk appetite to guide their trading decisions. It's important to note that even during periods with a lack of major news releases, unexpected events or developments can still impact the market. Traders should for July 12, 2023, the Core Consumer Price Index, CPI, will be released. The Core Consumer Price Index, CPI, is a measure of inflation that excludes volatile food and energy prices. It is considered an important economic indicator that provides insights into the overall price trends in the economy. When the Core CPI news is released, it can have various impacts on the market. 1. Interest rates. Central banks, such as the Federal Reserve and the United States, closely monitor inflation indicators like the Core CPI to make decisions on interest rates. Higher than expected Core CPI readings can signal rising inflationary pressures, leading central banks to consider raising interest rates to curb inflation. This can impact borrowing costs for consumers and businesses and may influence market sentiment. 2. Currency. Inflation is a key factor affecting currency exchange rates. If the core CPI shows a significant increase in inflation, it may lead to expectations of higher interest rates, which can strengthen the currency. On the other hand, if the core CPI comes in lower than expected, it may weaken the currency as it suggests lower inflationary pressures. 3. Stock market. The impact of core CPI news on the stock market can be mixed. Generally, a moderate level of inflation is viewed as positive for stocks, as it indicates a healthy economy. However, if the core CPI shows unexpectedly high inflation, it can raise concerns about the impact on corporate profitability and lead to market volatility. 4. Bond market. Inflation erodes the purchasing power of fixed income investments like bonds. If the core CPI indicates higher inflation, bond investors may demand higher yields to compensate for the expected loss in purchasing power. This can lead to a decline in bond prices and an increase in bond yields. 5. Sector performance. Different sectors of the market can be impacted differently by changes in inflation. For example, rising inflation can benefit sectors such as energy, commodities, and certain consumer goods, as their prices tend to increase with inflation. Conversely, sectors sensitive to rising input costs, such as companies in the technology or manufacturing sectors, may face challenges in maintaining profit margins. It's important to note that market reactions to economic indicators like the core CPI can be influenced by a variety of factors, including market expectations, overall economic conditions, and geopolitical events. Traders and investors analyze these indicators in conjunction with other market factors to make informed decisions. For July 13, 2023, the Core Producer Price Index (PPI) will be released. The Core Producer Price Index (PPI) is a measure of inflation at the producer level, which excludes volatile food and energy prices. It provides insights into price trends for goods and services before they reach consumers. The release of Core PPI news can have several impacts on the market. 1. Inflation expectations. The Core PPI is closely watched as an indicator of inflationary pressures in the economy. Higher than expected core PPI readings can indicate increasing input costs for producers, which may be passed on to consumers in the form of higher prices. This can raise inflation expectations and influence market sentiment. 2. Interest rates. Central banks, such as the Federal Reserve of the United States, closely monitor inflation indicators like the core PPI to make decisions on interest rates. Higher than expected core PPI readings may suggest upward inflationary pressures, which could prompt central banks to consider tightening monetary policy by raising interest rates to control inflation. This can impact borrowing costs and influence market dynamics. 3. Currency. Inflation and interest rate differentials can impact currency exchange rates. Higher than expected core PPI readings may lead to expectations of higher interest rates, which can strengthen the currency. Conversely, lower than expected core PPI readings may weaken the currency, as it suggests subdued inflationary pressures and potentially lower interest rate expectations. 4. Stock market. The impact of core PPI news on the stock market can be mixed. A moderate level of inflation is generally viewed as positive for stocks, as it suggests a healthy economy. However, if the core PPI shows unexpectedly high inflation, it can raise concerns about the impact on corporate profitability, particularly for companies facing rising input costs. This can lead to increased market volatility and potential adjustments in sector performance. 5. Bond market. Inflation erodes the purchasing power of fixed income investments like bonds. Higher than expected core PPI readings can raise concerns about potential inflationary pressures and may lead bond investors to demand higher yields to compensate for the expected loss in purchasing power. This can result in declining bond prices and higher bond yields. It's important to note that the market impact of economic indicators like the core PPI can be influenced by various factors, including market expectations, overall economic conditions, and geopolitical events. Traders and investors typically analyze these indicators alongside other market factors to assess the overall economic environment and make informed decisions. For July 14, 2023, the University of Michigan Consumer Sentiment Index will be released. The University of Michigan Consumer Sentiment Conversely, a decline in consumer sentiment may suggest reduced consumer spending, potentially leading to market volatility and impacting sectors such as retail, consumer goods, and services. 2. Economic outlook. Consumer sentiment reflects the perceptions and expectations of consumers regarding the economy's future performance. Positive sentiment can contribute to an optimistic economic outlook, which may encourage businesses to expand, invest, and hire more employees. This can positively impact the overall market sentiment and contribute to stock market gains. Conversely, a decrease in consumer sentiment may raise concerns about future economic growth and potential market downturns. 3. Interest rates. Consumer sentiment data can influence the decisions of central banks regarding monetary policy, particularly when it comes to interest rates. Higher consumer sentiment may indicate a robust economy and could lead central banks to consider raising interest rates to prevent excessive inflation. Conversely, lower consumer sentiment may signal economic weakness, which may prompt central banks to lower interest rates to stimulate economic activity. 4. Currency. Consumer sentiment can impact currency exchange rates. Strong consumer sentiment suggests a positive economic environment, which may attract foreign investment and strengthen the domestic currency. On the other hand, weak consumer sentiment may lead to a decrease in foreign investment and potentially weaken the currency. 5. Bond market. Consumer sentiment data can influence bond markets, particularly government bonds. Positive consumer sentiment may raise expectations of stronger economic growth, potentially leading to higher interest rates and increased bond yields. This can result in declining bond prices. Conversely, weaker consumer sentiment may lead to expectations of slower economic growth and lower interest rates, potentially resulting in higher bond prices and lower yields. It's important to note that market reactions to economic indicators like the consumer sentiment can be influenced by a variety of factors, including market expectations, other economic indicators, and geopolitical events. Traders and investors typically consider these indicators alongside other market factors to gain a comprehensive view of market conditions and make informed decisions.